Nike just tanked by 20% in a single day, but was the crash of this world-class company justified, or are their fundamentals still intact? Today's video will be an in-depth analysis of Nike's stock, covering business operations, fundamental, and technical analysis, in order to determine if this could be a rare buying opportunity. Now we'll dive into Nike's business operations by segment and geography to determine how and where they generate revenue, in order to uncover the breadth and diversification of their business. If you live on Earth, you probably know Nike is predominantly a shoe company, which makes up 65% of their total revenue, according to their most recent quarterly report, followed by apparel at 27% of revenue, and their last two meaningful business segments are equipment at 4% of revenue and Converse, also at 4% of revenue. I didn't even know Nike owned Converse, but they have since 2003, when Converse had a revenue of only $200 million. Now the Converse brand currently generates $2 billion in revenue. By geography, Nike is primarily an international company, with 57% of their total brand revenue being outside of North America, leaving 43% coming from North America, although as a single region, North America is still their largest geographical segment. Now we'll check out the most meaningful metrics for analyzing a business, starting with revenue. Here we see Nike's revenue in billions of dollars on the right over 10 years, which has grown consistently but not quickly since 2015 by a modest compound annual growth rate of 5.3%. But we can see since 2023 their revenue has been flat. If we shorten our time frame to the last 2 years, graphed quarterly, we can see their most recent quarterly report was slightly down year over year by a decline of 2%. But this same report drove the stock down 20% in a single day. This is my first indication of value for Nike, a huge discrepancy between market price and fundamentals. Now we see their earnings per share over 10 years on the left, which has grown substantially faster than revenue, by a CAGR of 7.3%. And their free cash flow on the right has grown similarly, but both are far less consistent year over year and show a large division of growth before and after the event that affected the globe in 2020. When we shorten our time frame again, we see their quarterly EPS year over year grew substantially by a rate of 50%. Or if we look at this year compared to last year, their EPS has still grown by a CAGR of 10.4%. which to me is another indication of mispricing by the market, considering the single-day drop of 20%. But as we'll get into later, the market is forward-looking. Now we see their shares outstanding on the left, which has been shrinking consistently by a CAGR of 1.4%, which is solid for a company of Nike's market cap, currently at $114 billion, showing that even with their large market cap, they are still able to take a meaningful amount of shares off the market, which is partly because they have such little debt to manage, especially if we consider their cash on hand. If we take their total liabilities, which are currently at $23.7 billion, and add back their cash on hand of $11.6 billion, they have a true total liability level of only $12.1 billion, which is 2.1 times their trailing 12 months net income. I've seen very few companies with this little debt, which is especially advantageous currently, with interest rates being so high. Now we see their dividend payout ratio as a function of EPS on the left, which has been amazingly low at a 10-year average of only 35%. And their highest payout ratio in 2020 was only 52%, while their current payout ratio is still low at 36%. And in general, the payout ratio is growing slowly, unlike what we've seen with so many other companies who grow their dividend at the expense of company growth. So their payout ratio is low, but check out this amazing dividend growth history, which has grown for 22 years and has been uninterrupted for 40 years. They've had a 10-year dividend CAGR of 12%, a 5-year CAGR of 11%, and their TTM growth rate is still high at 9.4%. But the sad news is that with all this dividend stability and growth, their starting dividend yield is only 1.9%. Although this yield is a 5-year high and is 89% higher than their 5-year average dividend yield of 1.0%. In terms of valuation, Nike is trading at a massive discount compared to its 5-year average PE ratio, which we see graphed here with a TTM PE ratio of only 20.2, which is a 37% discount compared to its 5-year average PE of 31.9. Better yet, the current PE ratio has never been this low over the past 5 years, not even in 2020. Or if we compare Nike to the iShares Consumer Discretionary ETF trading at a current PE of 28, Nike is still at a huge discount of 28%. So Nike appears to be a stable dividend growth stock trading at a fairly low valuation, but how can we explain the recent plummet in stock price? Well, before the one-day crash, Nike was trading at a PE of 26, which is fairly high for a company that is slow growing. And growth investors have probably lost interest in Nike, so Nike has shifted from a growth stock to a value stock for the time being. Or from a dividend perspective, Nike had such a low yield that it wasn't really suited for a dividend growth investor either, especially since shoes and shoe brands are less safe than a company like Microsoft, for example, who provides essential products and software. Also, Nike released their guidance for their next quarter, which projects a revenue decline of 10%. And the talking heads have determined this is the reason for the crash. But what do you guys think? Does a projected revenue decline of 10% justify a one-day price drop of 20%? Let me know your thoughts or what I'm missing in the comments. Now I see Nike over a 5-year period. The first buy criteria I'm checking for is an uptrend, which is not the case for Nike at this moment as the price has been basically flat. The next criteria I'm checking for is a below average price, which is depicted by the center yellow standard deviation channel line, which is currently at $116, which is far higher than the current price of $75, meaning Nike is currently 35% below its average price, which indicates a massive discount. In terms of support and resistance, Nike recently broke a prominent support level around $88. Then it broke another support level around $82, and the last support level we have on this time frame is the 5-year low of exactly $60. Or a price could react off of the bottom of the 5-year standard deviation channel line. The last indicator we see is the relative strength index, which indicates a very opportunistic buying point, especially if we consider that each time the RSI was this low in history, price reversed in the short term, like it did in September of 2023, October of 2022, and less significantly so in May of 2022 and March of 2022. And lastly, when the RSI was this low in March of 2020, the price rocketed all the way from $60 to $179. Although all these indicators should be used in conjunction to determine a buying opportunity and in correlation with fundamental analysis. Not to mention the S&P 500 looks to have topped out too, being far from the center standard deviation channel line, far from the EMA lines, and overbought according to the RSI, and seems to be due for a short-term reversal. And so does the consumer discretionary sector ETF, IYC, which is failing to break resistance. It's above the center standard deviation line, far from the EMA lines, and overbought according to the RSI. If you want to see another video of a stock trading at an even lower PE ratio with an insane growth track record, check out this video covering Alta stock. Thank you for watching.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.